All right, greetings everybody. Welcome back. Happy Wednesday. Hope everybody's having a good trading day thus far, at the very least. But Chris here, we are back ready to rock and roll with another weekly Wednesday discussion. And today we are going to be diving into the VWAP. So those of you that are some of my moving average fans, the VWAP is we'll call it the next level, if you will. But going to go ahead and dive on into that. But without further ado, let's get these disclaimers out of the way. These pesky disclaimers that have never changed, that we're required to show because we like to do things the right way. So here they are. Just bear with me for a moment. I'll get them through and over with as fast as possible. But once again, if you already know what they are, you don't have to read a single word of it just because you already know them and the words have not changed. So good time to get your coffee intake up. Moving along. Got some Irish beans myself at the moment. I like to brew my my coffee the same day that I grind the beans, and they are quite good. I'm trying to try a different bean every bag, if that makes any kind of sense. But these are oddly quite good if you're interested. Dead Rabbit is the brand. It's quite tasty. Moving along. We are almost done, folks. Congratulations. Alrighty. Wonderful. We did our disclaimers. We got the boring stuff out of the way. Now we get to move on to the fun, juicy stuff that follows, which is stuff that revolves around trading and practical things in terms of things that we're actually going to be used. You know, maybe today, maybe some of you won't use it for a month. Maybe some of you won't use it for a year. But the point is, at some point, you absolutely will have the ability to use the information if you so choose. And here we believe knowledge is power in the trading world. The more you know, generally, the better off you are. There is just a strong correlation there because just, you know, even if you're aware of a particular strategy that you don't want to use on a daily basis, it's good to know because you're prepared to use it, or you have options, which kind of eases that trading pressure. If you only know one strategy and that type of scenario or market conditions that are conducive to that working correctly are not present, sometimes we feel pressured. But if we know a few other options, even if we don't choose to use them, we sometimes feel a little bit more relaxed because we know we have those options, whether or not we choose to exercise them. So I always like to try to bring different ideas, talk about different indicators, different assets and things, but mostly trying to bring something that you can add into that trading arsenal, something that you can keep up there so you can bring it out. You can hit the red button if you so choose, or if not, then you can always, you know, just keep it up there and keep the brain stimulated and keep you thinking about different ways and new angles and other ways that traders are executing in the market that might be a little bit different than your own. And today, the indicator for discussion, our indicator insight, if you will, is going to be something called the VWAP for short. Now, the full name of this is the volume weighted average price, as you can see on your screen. And first things first, let's go ahead and go through the adding it to our chart section just so everyone's on the same page. And we'll flip on over to a prettier backdrop, if you will. So here we are currently looking at the E-mini S&P 500 on a 15-minute chart. So nothing too crazy going on this morning as of yet. We've had a little bit of volatility a few hours back, but really just holding on to the bulls right now, kind of watching some bullish pressure push the market up. But let's go ahead and get the VWAP, the volume weighted price average. I'm sorry, guys, the volume weighted average price on your charts. And I have actually seen it, even though I went a little bit dyslexic there, I have actually seen it called the volume weighted price average before. That is not correct, but there are places that will actually list it that way. So don't get thrown off if yours is one of those platforms that, you know, lists it with it as price average instead of average price. But nonetheless, here we go. So indicator options, as always, guys, is going to be in the top center portion of your screen. It's going to be this little icon that looks like a chart. We're going to click on that there. And it's going to pull down some available indicators for us to choose from. Now, these are all the indicators, obviously, as we know, that we can apply to section 1, because that is the only section that we have listed at the moment. Now, as we look down this list, boom, right here, second to last, there actually is the VWAP. And that's because VWAP is one of the indicators that does overlay price. Remember, there's a much larger list if we were to go ahead and add a section 2, and that's where we find the majority of our indicators. But luckily with the VWAP, it is something that overlays price, much like a moving average. So we're going to go ahead and click on this down here. VWAP it is, and boom, it's going to go ahead and add it over here under section 1. So you'll see candlesticks, and you'll see VWAP on those candlesticks. And we're going to go up to the top center and click the chart icon yet again to hide the indicator options, and away we go. So just like that, we have now applied the VWAP to our charts. Nothing more, nothing less. And it looks a little strange at first, right? It looks a little strange because we see this weird line that kind of moves along. Sometimes it's flat, sometimes it's, you know, sometimes it's going straight up, sometimes it's going straight down, but it doesn't always have a smooth, you know, linear curve, if you will. It's not as easy on the eyes as a simple moving average or an exponential moving average, with some of the abrupt turns and changes that it tends to have, right? So let's talk about what in the world this is, because obviously we need to know what it is if we're going to use it. So the volume weighted average price, and let's go ahead and get our notepad handy dandy ready so we can take some notes if we so choose, or at least I'll take them for you. So we're going to be talking about the volume. My keyboard, by the way, I promise I'm not as bad as a typer as it looks, has for some reason become possessed, and it likes to double type letters. It's actually kind of confusing. But anyway, you can hit E and occasionally it'll double type an E or an R, et cetera, et cetera. But so the volume weighted average price is also known, folks, as what? As the VWAP. Okay. So we've got the volume weighted average price known as the VWAP. And what is this thing? Okay. So let's talk about that. What is it? Shall we? So the volume weighted average price, the VWAP, and that's how we're going to refer to it from this point on forward, because I don't want to say that entire thing because it's such a mouthful, but it is simply a trading benchmark, okay? Essentially an area that traders can look at that gives us an average price of a, you know, a security, whatever asset that we're taking a peek at. You know, it could be the E-mini S&P 500, it could be CL, it could be NQ, it could be Forex, or well, not Forex directly, it could be, you know, Forex futures, it could be, there's all kinds of different things that we could add it to, right? So based on volume and price, the line that you're seeing in the background is calculated. We're going to talk about exactly how to calculate that if you're some of my more old school followers that like to do things on your own and don't want to be reliant on any, you know, nifty thrifty indicators. But the VWAP is important because it gives us an insight into both trend as well as the value of something that we're looking at, okay? So it's calculated by adding up all of the price multiplied, and let's go ahead and start taking notes here. So how is it calculated? You know what? Let's title it this way. How it's calculated, and we'll just be definitive in that sense instead of asking a question, but adding up the price, and then this is going to be multiplied by the number of shares traded, and adding up price So we're going to have adding up price multiplied by the number of shares traded, and then we're going to simply divide. There it goes. We got a double B there. Divide by the total shares traded. Okay. So everything you see here, we'll break it down so it actually looks like the equation, hopefully. I'll do it like this. There we are. And we're going to do a little, there we are. So let's see if we can get that a little bit centered more. All right, wonderful. So essentially looks like the way the equation should read. So once again, we're going to solve for the VWAP by simply having price multiplied by volume. Okay, this is the easier way to remember it. It's going to be price multiplied by volume, which obviously would be the number of shares traded, the number of contracts traded, the number of whatever it is that we're looking at is going to create your volume, right? So it's going to be price times volume simply divided by volume, and that is going to calculate your VWAP, right? Price times volume, and that is going to calculate price times volume divided by volume, and that calculates your VWAP. So what is the VWAP, and where does it come into play with us? Well, if we understand what the equation is, how do we actually go about that? So if we're going to go ahead and find the average price, and we're actually going to go through the process of doing it manually, the way we do that is simply by finding the average price that, say, the E-mini S&P 500 here or anything else that we're looking at, traded at for the first 5-minute period of the day. Okay, so we can go ahead and do our charts and go over to the first 5-minute period of the day, wherever that might be, depending on what type of chart that you're looking at. So if we want to make it simple and look at each candle as a 5-minute bar, we're going to switch over to 5-minute bars, and we're going to go to the open, and we're going to find the first 5-minute candle of the day, which obviously, depending on whether you're doing it literally in terms of the time the clock ticked over or the cash open, is going to be something that you may dictate on your own if you so choose. A lot of people are going to calculate by the cash open in and of itself and not by the exact open of the day, but a lot of indicators will calculate by the exact open of the day. But nonetheless, how you choose to solve for it is going to be just a matter of personal preference. There is no right or wrong answer, as you'll understand as we go here forward. So step one is to find the average price that something traded for the first 5 minutes of the day. All right. And remember, to do this, it's simple, okay? To do this portion, all we're going to do is add the high, the low, and the close, and then just simply divide by those three, okay? And when I say by those three, I just mean by literally the number 3, because there's a high, a low, and a close. We're dividing by the number of things that we have added up to get an average. I'm sure everyone here is capable of understanding an average, so we're not going to spend too much time on that. But once again, it's high, low, and close of the first 5 minutes of the day, and then divided by 3, okay? And then we multiply this by the volume for that period. And that's the only time that the VWAP starts to seem a little bit strange, is once you start to throw in the volume. So after we have the volume for that period, we would want to, if we're going to do it by hand, we would record it on a notepad or a spreadsheet or something. And we're going to go ahead and keep that as the opening VWAP value. So we'll call it X, if you will. So we would then divide X by the volume for that period, and that would give us the VWAP value. And then in order to continue that line forward, or the way that it's working, guys, all we're going to do is to continue to add that value from each period to the prior values, doing the same thing with each 5-minute period. And then we're going to continue to divide that total by the volume up to that point to make it easier. Now, once again, if you didn't understand all that, obviously you can absolutely pause this and watch it back at any point in time, but it isn't something that I expect many of you will be doing by hand. It's just something that I wanted to provide for the sake of being, thorough and talking about the VWAP, and we're going to move along quite quickly from that. But that is simply the way to calculate the VWAP. It's not anything more complicated than simple math. It's just adding things, finding an average, and then continuing to maintain that average to plot something. But nonetheless, so when we're looking at the VWAP, the rest of us that are going to use just simply the VWAP indicator, which is available on many platforms, it's going to make it a lot easier than having to do the math for us. It's going to make it a lot easier for us to be lazy, but at the same time, we've got a lot of stuff going on, so we do not need to feel guilty about feeling lazy. I'm going to tell you right now, guys, I do not ever sit here and just manually calculate the VWAP, even though it is, something simple. If I have an indicator that it's going to do, I'm going to let it do it for me so I can focus my attention elsewhere. But what does the VWAP tell us? As a trader, what is it letting us know? Let's talk about that. So large institutional buyers and the big guys that are behind the scenes, a lot of them will use something along the lines of a VWAP or a VWAP directly, some kind of ratio in relation to it, basically to help them move in or out of the market without a large market impact. So obviously the goal for the people that are executing the large orders, those large institutions, the ones that are trying to get into the market, execute a large number of buys or a large number of sells, they want to do it without causing a massive stir, generally speaking. Sometimes maybe they do want to cause a stir, but generally speaking, the goal is they want to get their orders in, and they don't generally care as much about what you're doing. They just want to get their orders filled, and that's priority number one. And then obviously, if, messing with your orders is what they have to do in order to get their orders filled, that's a whole nother discussion. But remember, they want to get in, and they generally want to get in without causing a massive stir. Hopefully, kind of slide into the market, slide out smoothly. And the VWAP is one of the things that they might be using in order to do that, because it gives them an average price, right? It stands for volume weighted average price. So if they're trying to get in without causing a massive impact, well, they would generally be looking to buy below the VWAP or probably sell above the VWAP. Now, that is under the premise that now their actions would push price back towards the average instead of away from it. So the idea is that the institutions are looking to jump in when price is below the average for their buys. Why do they want to buy when price is below the average? Because it's easier for them to push towards the average than it is for them to push away from the average. Just think about pushing a rock up a hill or pushing a rock down a hill or a boulder or anything along those lines. They're trying to go with the ebb and flow. We talk a lot about how the trend is your friend. Even the big guys are in some degree anticipating using some type of return to normality or some type of status quo in the favor of their executions, right? So generally speaking, if you're seeing price below the VWAP, that is going to be one of the times where you're anticipating some of the larger institutions to be interested or eyeing potential entries into the market. Now, there's going to be a lot of times where the market's above. There's going to be a lot of times where the market's below. Of course, they're not going to be buying and selling every single second that it's below and every single second that it's above. And we'll talk about a little bit more as we dive deeper. But it's very common for traders, not even just the institutional ones, to use the VWAP as a trend confirmation tool and then build trading rules around it. Okay, so for example, when price is above the VWAP, as you can see on the right-hand side of the screen, when price is above the VWAP, they might prefer to initiate long positions just due to the fact that the market is said to be in a bullish manner if we are above the VWAP, if we are in a bullish market and we're witnessing a strong prowess of buying, we're witnessing a lot of buyers come in and it's pushing the market higher and higher. Well, that is what being above the VWAP says. It says we're above the average. There's stronger than normal buying occurring, okay? And the opposite can hold true for traders as well. Some traders will say, okay, if price is below the VWAP and there's only like a brief period here on the far left, we'll have to shift a little bit where we dip below. And again, here towards the center of the screen, when it was kind of moving sideways, there's periods where the market is below the VWAP. And traders will at times use the VWAP as a trend confirmation tool to say, okay, we are in a bear market. We are in a bearish market. We're watching sellers dominate and control the market. and I want to stay with the flow of traffic. I want to stay with the, the flow of the tides here, and I'm only going to be looking for short positions while the market is below the VWAP. Both of those are possible. And you might be saying, well, Chris, didn't you just tell me that large institutions are interested in buying below the VWAP? Yes, they are. But of course, they're not interested in buying just because we worked below the VWAP for just a very short period of time. Generally speaking, normally in a perfect world, the best scenario for anybody, large institution or retail trader alike, it does not matter. We want to buy low and we want to sell high. And those words, low and high, are obviously all relative, okay? So we want to buy at the lowest price that we expect to be available to us relative to the time that we are trading. And we want to sell at the highest price that we expect to be available to us at the time that we are trading. So just because price immediately dips below a VWAP does not mean that that large institution is expecting that price to be the lowest. They might be looking for it to be a certain distance below that VWAP or a certain distance above that VWAP in theory. So once again, both ideas are possible. We're going to talk about a couple different strategies here that go into play with that. So distance below the VWAP is something to take into consideration. Something similar, a similar concept that can be equated to the use of Bollinger Bands. And we're actually going to be throwing Bollinger Bands in to talk about some strategies here with the VWAP as well. But nonetheless, so the difference between the VWAP itself, because it does just simply look like a moving average, the difference between the volume weighted average price, okay, the VWAP, and a simple moving average is obviously going to be the fact that the VWAP is calculating the sum of price multiplied by volume and then divided by volume. Okay, remember, it's the sum of price just multiplied by the volume of the time period that you're analyzing, and then it's just divided by the total volume, okay? Whereas a simple moving average is just calculated by summing up closing prices over a specific period. So a 10-period simple moving average, a 10-period SMA, is just going to be the closing prices over 10 periods divided by 10. Volume is not factored in. Okay, so the big difference between a simple moving average or an exponential moving average and the VWAP, which is the volume weighted price average, volume weighted average price. I have no idea why I have such dyslexia sometimes with my brain. I actually will stop for a moment just to think that I was about to say it right, and I still somehow speak backwards. I do that with words. I have no idea why. Maybe you can relate, but nonetheless, the volume weighted average price, VWAP, is something that's going to be calculated with the volume as part of the equation, of course, because it's multiplied by volume, then divided by volume. And that is the key defining factor between the VWAP and an SMA or an EMA. And the reason that matters is because it is actually taken into consideration the activity that's going on in the market. It's taken into consideration how active the market is. Okay, how many orders are being filled? What is going on in the market? Is the market slow? Does that matter? Yes, it does. Is the market active? Very active? Yes, it does. It does matter because it's going to change the equation, because obviously in an active market, the volume's higher. That's going to create a higher division, right? It's going to create a higher multiplication and a higher division when the dust settles. That's absolutely going to impact the way the VWAP looks. Meanwhile, an SMA and an EMA are always going to simply be an average of the last, whatever period that we're analyzing closing prices. So the VWAP does take into consideration activity in the market, and that is something that is quite nice. But anywho, there are limitations that we should talk about as well before I dive into some direct strategy and looking at some entry opportunities as well as some stop loss, because that's what comes next, folks. There are some limitations, though, that should be mentioned with the VWAP, right? And generally speaking, we look at the VWAP as being a single day indicator that's restarted at the open of each new trading day. Okay, and attempting to create an average price, attempting to create an average VWAP over many days could mean that the average becomes a little bit distorted from the true VWAP reading. Okay, so while some large institutions may prefer to buy when the price of a security is below the VWAP or sell when it is above, the VWAP is not the only factor to consider in, as when we're trading, we never want to consider just one thing, of course. So in strong uptrends, the price may continue to move higher for many days without dropping below the VWAP or only dropping below it occasionally. And therefore, if we were waiting for the price to fall below the VWAP, that means we could miss an opportunity if prices are rising quickly, so we could kind of be sitting on our hands for a while. Now, that's not a bad thing, so to speak, as relative to taking a bad trade, which is still good. But the VWAP is based on historical values and does not inherently have predictive qualities or calculations, so we do consider the VWAP a lagging indicator. Now, because the VWAP is anchored to the opening price range of the day, the indicator is something that's going to increase its lag itself as the day goes on, okay? But nonetheless, those are some notable downsides about the VWAP, but everything is going to have some type of a measurable downside. In trading, there's going to be something that's going to cause something positive, and there's going to be a way to interpret something as a negative. And I always try to bring you guys absolutely everything, every single way that you could possibly interpret whatever it is that we're looking at, and let you guys make your best judgment. Now, let's talk about some entry opportunities that people are using and people have definitely used in the past to find some great opportunities with. So simply looking at the VWAP itself, we can already find execution material, okay? And there's ways that we can do this, and that is simply by looking at the VWAP and looking for either a breakout or a pullback. And we're going to talk about those two first. So what does a breakout look like? Well, let's focus in on this part of the chart. This is also known as a VWAP cross, okay? Once again, volume weighted average price, VWAP cross. And what are we crossing? Well, we're crossing the VWAP. The VWAP is literally just going to be a line. So there's not a whole lot to get confused about here. So what are we looking for? Well, we're looking for a time when price crosses and closes above the VWAP after having spent some time below the VWAP. The longer below, the better, generally speaking. But after spending some time below the VWAP, and then finally closes and starts trading above the VWAP. That, by the simplest definition, is exactly what a VWAP cross is. And you're actually looking at one right around this area. Whoops, hold on a second there. You're actually looking at one right around this area here. We'll use a nice green box right here. There we are. So that'd be an example of a VWAP cross, okay? In a very micro way, it is also an example of a VWAP cross as well as a VWAP pullback. But we're going to use it more as a VWAP cross example, and then we'll talk about a little bit of a more drastic VWAP pullback scenario. But the VWAP cross would be when we saw price cross above the VWAP, which obviously is our blue line here. You can change it to any color. But we crossed above the VWAP, and at this point, because we had been trading below the VWAP, the read here, the way that we interpret this, our technical analysis here is going to say, okay, we're now closing above the VWAP. This is something that is conducive to strong buying and buying controlling the market. We're flipping from the period where the bears were in control to now the buyers are looking to be taking control of the market. So we use that as a bullish trigger point. And at its most blunt sense, we could theoretically look for a buy because we have now closed above the VWAP and look for an entry. Now, the thing that I like to do is inherently going to make it sound a little bit like the next version of this strategy, but I do like to wait until we have, if I'm trading a VWAP cross, I like to wait till it has traded above the VWAP. Okay, if I'm looking for a long or trading below, looking for the short. But if we're looking for it to trade above the VWAP, I want it to close above the VWAP, and I also want it to back test quickly. I want it to come down and touch my VWAP without closing below it. And that's actually what we had going on here. You see the small little red candle. I'm actually going to try to zoom it in a little bit more for you. All right, that'll work. So we came up right here. Okay, and we closed above the VWAP. We had a nice strong bullish close above the VWAP. It was actually relative to the last hour or so before that, it was a high point. And then the next candle immediately thereafter actually dropped down, kissed the VWAP to the tick, and then began working its way off of that. So this is what I'm talking about by waiting for some type of early confirmation. Now, this also brings us in to the next strategy that traders are using when executing based on the VWAP, and this is going to be slightly more in depth, and each of these strategies are going to get slightly more in depth as we go. So once we add another layer of confirmation to it, generally by doing that, we're going to be adding ourselves, usually the more strict we are, the more conservative we are, generally speaking, the less trades that we're going to find, but usually the theory is the quality of those trades should be higher. And this next strategy would be looking for the VWAP cross. Okay, once again, bullish or bearish, doesn't matter. We're just going to reverse the entry rules for either or. So if we're looking for a long entry with the VWAP and we witness price traveling below the VWAP, we're going to be prepared for the long VWAP because we're waiting for the time that price crosses above the VWAP. And here it did. So it crosses above the VWAP, but we're not going to jump in just yet. We're not going to jump in just yet because actually what we're waiting for is we're waiting for a retracement. We're waiting for a pullback to the VWAP. We want to look for a pullback to the VWAP, and then we want to look for our long at that point. Now, realistically, this initial pullback happened as we were crossing, and that's too darn rough for me to consider that a pullback right off the bat, even though I consider this a test, that little area that we were talking about right here. I consider this a quick test of the VWAP, not a direct pullback. I don't see price finding a trajectory, climbing high, and then drawing all the way back down over a series of candles. That is, by my definition, what a pullback should be. A pullback should be a period of candles, a trajectory of price drawing back down to the area in question. So what I'm actually looking for is we got close here, didn't come all the way down, and then here we did. Okay, so at this point, this is what I'm going to consider ourselves to be in a scenario where we have found a pullback to the VWAP after the VWAP cross. So remember, this is just adding one more step to a VWAP cross entry. Instead of just getting in for the long because we have crossed above and showed some type of a VWAP hold, we're waiting for the VWAP to cross above and then actually draw back down at some point here. We're waiting for the VWAP to draw back down and then hold. Okay, we want the VWAP to come back down and hold on the level. And it is okay if this one's a pretty perfect example, but it is okay if the VWAP does drop a little bit, or I'm sorry, if price drops a little bit below the VWAP, as long as you're getting price action that is conducive to finding some type of stagnation of the selling in this scenario where we're trying to find some type of stability. If the buyers look like they're getting a bit stronger here and they start finding some strength anywhere around the VWAP and it looks like we're starting to bounce our way right back up, that is exactly what we're looking at. We're looking for some type of a bullish trigger after price has been on a bullish run above the VWAP and then drawn back down to it, but is now holding and bouncing back up. That is good news. And the way that we interpret that as a trader, as an opportunity to get in at a good value moment. It is a moment of value because price is still trading above the VWAP. Price is still trading above the VWAP, which is a bullish sign. And instead, price has just temporarily drawn back. And we're trying to use this in theory or an expectation that we're now getting a nice low price in order to ride the trend as it sits. So that would be an example of an entry option. Number two would be looking for a VWAP cross followed by a pullback and then jumping in on the pullback for the direction. If we were looking for a short, okay, if we were looking for a short, a hyper zoomed in example might be, this is a really, really terrible example, but it might look something like this, for example, where we have here on the left, let me use a little box for you. Use a little red box. Okay. So this might be an example of a VWAP short that would be found from using a pullback scenario. Now, once again, this is just hyper zoomed in. This is just a rough example. I just don't feel like searching for, the perfect scenario for 5 hours through the charts. But what we have here is a rough example where price closed well below the VWAP after temporarily trading above the VWAP. And then we saw price come back down to this area on a series of price candles. So we got ourselves a pullback that wasn't just a simple text of the next candle. And then we'd be looking for a short because the VWAP held. We'd consider this a drawback to the VWAP. So we'd be looking to short the market lower. Now, this is a micro transaction. We would not be looking for a long trade, like a long-winded trade. Obviously, we're not looking to buy here, but we would be looking for a great deal of distance off of this type of a scenario because this is a very zoomed in candle. We're looking at 5-minute candles. We're literally covering a period of like 25 minutes here on the left, but nonetheless, that is the scenario, and that is what we should be seeing with the candles in order to dictate some type of a VWAP drawback in order to jump in for the short. Just like with a long, as we zoom back out, we come back over here. We have our bigger example. Ignore that red box. All right, there we are, where price crossed above the VWAP on the left over here, traveled along, continued higher, and then actually drew back down to the VWAP, held at the VWAP, and then we'd be looking for a long entry to ride her on up. Okay, now, as with all things, there is going to be an importance to make sure that we have some kind of a stop loss in place. And some of the ways that we can have a stop loss in place when using execution methods like this is going to be based around simple price action or by using an intelligent distance below the VWAP. Now, what is an intelligent distance below the VWAP? Obviously, that is a relative term. In my world, that is going to be the last swing low that occurred before the break above the VWAP, in this case with the long, okay? So we had a swing low right over here, all right? So if we found a low right over here, okay, a stop loss below this area would make sense. Maybe we want to go just outside this tick, okay? Maybe we want to go just outside this wick, I should say, just, you know, maybe a tick or two below that wick in order to give ourselves, you know, a little bit more of an aggressive entry, a little bit more loose, you know, a little bit less conservative, if you will. But the idea is we're using something that was a previous area of support. The market had to create this low in order to find the strength to get above the VWAP. So it's an area of significance in the market. So setting our stop loss outside there would be a logical reason to do so. This isn't the only reason to find a stop loss. This isn't the only method that you can do to create a stop loss, and it's not going to be the only correct method either, okay? But this is just one example of how to set a stop loss based on this. And as far as the take profit goes, if you are just totally trading based on ratios, which is not a bad thing, okay? It's not a bad thing. It may not be your personal preference, but if you're trading on ratios, in order to find a take profit level and you are a 2-to-1 trader, all we would be doing in that sense is saying, okay, so the distance between our entry, somewhere around the VWAP line, and our stop loss, okay, so say it's like 3 points. All right, then if we're going to be a 2-to-1 trader, then we need to be setting a take profit somewhere at 6 points above our entry. That means we're now risking 3 points to make 6 points, all right? So that is a simple way to make sure that we have locked in ratios, but there are things that should always be considered when looking for those take profit goals. And we always want to pay attention and say, hey, is this a reasonable take profit goal, or are there a lot of resistance areas that the market is looking to break through in order to get to my goal? Because if we have a ton of barriers for the market to get through, it is entirely possible and more likely that the market might run out of momentum. It might run out of steam before it gets to the height that we're looking for. But nonetheless, those are a couple entry methods of getting into the market, as well as a way to set a stop loss method based on the VWAP as well. Now we're going to talk about a more complicated version that is still very easy. So when I say complicated, I use that term very loosely. It's just more complicated relative to what we're talking about. And that is going to be by adding, delete, this line did not want to delete. We're going to add Bollinger Bands to the market. Okay, so let's go ahead and do that. We're going to add it on top of the VWAP. All right, and this is going to be my favorite. Why are my chart shifted like that? What in the world is going on here? I just noticed my charts are shifted and there we go. Okay, that's better. My OCD was kicking in. Couldn't let that happen. My charts were shifted slightly down and it was cutting off the top portion of my chart screen. But anyway, so let's go ahead and add a Bollinger Band to the current chart. And we're going to go to the very top option here after we pull up the indicator options. And hello, there she is. Let's go ahead and close her on off. All right. And now let's see what we've got. Okay. So with the Bollinger Band, okay, at the moment, the Bollinger Band is highlighting an upper band and a lower band. The VWAP is the blue line in between, the orange dotted line. That is obviously our Bollinger Band. Now you're going to be saying, well, why does this matter? Well, there's a couple of really cool opportunities that we can do here. And that is simply going to be by giving us a method or stop loss location, as well as a take profit location based on the bands themselves. Okay, so what does this mean? Well, if we just understand anything about Bollinger Bands, we know that somewhere around 90+% of the time, we're anticipating to see price inside the bands. Does that mean it does travel outside the bands at times? It sure does, but the majority of the time, it is going to be above them. Just like the institutions are out here looking to buy price below the VWAP in a perfect scenario in order to push price back towards the average, because we know that the average is going to be the average location of price. So just by the, just by the simplicity of making sure that we're always aiming towards the average, we're always aiming towards where price is expected to be, once again, on average, we're using that theory with the Bollinger Bands as well. So as these bands tighten and widen, and we're looking at the VWAP to find our entry location in, we can use the bands as both stop loss and take profit locations. So you'll notice that with the swing low, oddly enough, our stop loss location, had we just simply used the Bollinger Band method, actually would have taken us right down here, right outside the Bollinger Band as well. They would have been a very similar location for our stop loss. As far as our take profit goes, if we want to be very conservative traders and we're looking for entries in based on a breakout above the VWAP or a pullback to the VWAP, the opportunity that's going to present itself is generally going to be something along the lines of looking for an entry in and then looking to cover our position. This doesn't mean we have to close the entire thing out, but we want to cover our position when we get above the top band. Okay, so that means if we got in at the VWAP location, a take profit and a safety net for us would be the moment that we're breaking above the Bollinger Band, because we know price likes to suck back down to it. We know that price likes to stay inside the Bollinger Band. So if we're getting above them, a very safe exit location to take our profit and run would be as soon as we're getting above the Bollinger Band, or at the very least to cover our position. So say we're into the position, we've got 2 contracts open, and we close one contract out to cover us, so we're guaranteed profit, and we move our stop loss to break even, and to make sure that we're the theoretically guaranteed profit, obviously, at that point, because if it comes back to break even, we're already sitting with micro profit, or once again just simply break even by locking in a 1 contract out at the Bollinger Band extension, and then we can leave another contract to run, right? So we can have our gold mine contract. We can do that. So and the reason that works, and that could be argued to be a very intelligent strategy for the market, is because we're buying in the direction of the momentum based on the average price, based on the volume that's going on in the market, and we're using the Bollinger Bands as the expected deviation there in order to use and lock in an easy expected area versus letting our 3rd contract go ahead and run out after we already locked in our guaranteed. So we're basically taking a free stab at the market at that point once we have one locked in, and we're letting the runner go. So this is going to be a strategy that is relatively simple, very, very simple to understand, and very sound, in my opinion. It is very sound indeed. It is something that new traders can definitely kind of pick up and play with, and it helps grow the understanding of the market, how it ebbs, how it flows, and watch how far the market does seem to stretch away from these weighted averages, or just moving averages, or expected deviation zones, meaning the Bollinger Band itself. But the volume weighted price average, we can watch and get used to how far the bands might stretch above or below that, and then we can get accustomed to knowing how far does it generally stretch above or below that before it starts snapping back. Now, there is at this point, would that be a 4th entry method? There is a 4th entry method that would also come into play by using these Bollinger Bands as well, that I'd like to talk about. So another way that we can look for entry opportunities with the Bollinger Bands would be to look for an execution when the market is extended outside of the Bollinger Bands as well as far away from the VWAP. So this is using the same theory that the large institutions would be using. If they know that price is expected to move back towards the average, okay, if they know price is eventually expected to move back towards the average or even back out, we're going to use that concept with the Bollinger Bands as well. And we know that with the Bollinger Bands, the price is generally going to be existing inside of those 2 bands. What we can look for is a time where the VWAP, for example, is or we'll say price itself. We'll look for a time where price is quite far below the VWAP, okay, meaning we're expecting price to be moving back towards the average. Price is below the average, okay? Price is below the average. It's a little bit too cheap at the moment, and we're expecting some type of a correction to happen. That's what we're understanding when price is below the VWAP, but also not when it's just below the VWAP, but it's below the VWAP as well as outside of a bottom Bollinger Band, which we had happen right here. Okay, now this is a very sideways period in the market that I'm analyzing at the moment, so it isn't going to be the cleanest example, but it is an example nonetheless. So this would be a scenario where price found a way to work below the VWAP. We had a VWAP cross, and then we fell below the VWAP a distance, and then we also fell below the Bollinger Band. So it was a more exciting bearish event than currently going on. It is more bearish than average. Price is being sucked down more than the average, and it's falling so far that it's going outside of the Bollinger Band as well. So what the goal would be, our goal would be to target an entry opportunity, a buy somewhere outside of the Bollinger Band and below the VWAP, with an expectation that we're going to be moving back towards this average. So the goal here, and what is going to look more beautiful to us as a trader, the farther we are away from the average, the more our eyes should light up, green with those dollar signs, right? Because we're looking for an opportunity to jump in with an expectation of an average holding true. And the farther we are away from the average, the more likely it is that we're going to have a move back towards the average. Why? Because an average is an average for a reason. It's just the way that the numbers are going. Now, does the market have to do that? No, but historically, what has the market done? It has moved back towards the average, and that's what we're doing. We're using historical data to interpret what we expect the future to do. So with this scenario, we have the Bollinger Band once again here, and the price is below that. And obviously, if it's below the Bollinger Band, the bottom band anyway, we are definitely below the VWAP. So we have ourselves a scenario where we're looking for an entry opportunity in, just based on price being entirely too overextended, with the expectation that it's going to move back towards the average. And what can we use as a take profit goal or a stop loss goal, or et cetera, et cetera? Well, the take profit goal is going to be one that's quite fun, because if we're buying outside the bottom Bollinger Band, we can use a take profit goal of reaching the top Bollinger Band. Or if we want to be very conservative, we can use a take profit goal of reaching the VWAP average itself. So we can use a take profit of just at the VWAP line itself, because once again, what are we expecting by the statement of jumping in based on this information? We are expecting price to be moving back towards the historical average, which means we can look for the take profit location right around this line here. So that is another entry method that people are using with the VWAP. And once again, another solid entry method just by the numbers, because once again, historically, how much of the time is price going to be inside the Bollinger Band? Okay, it's going to be well above 90% that we're expecting price movements to stay inside those Bollinger Bands. So that means, in theory, if we're buying outside of the Bollinger Bands with the expectation for price to come back inside the Bollinger Bands, well, we know that 90% of the time price is going in there. Does that mean 90% of our trades are going to win? No, that is not what I'm saying. But once again, we're using that information to be able to get an edge on where price is anticipated to go. And it can lead to some very excellent opportunities, indeed, if done correctly. But nonetheless, that is the magic of the VWAP itself. But anywho, got a message. I came late. Well, good news for you, actually. Okay. And I'm not saying that sarcastically whatsoever. Good news for you is the presentation, everything that we're talking about, as always. When we always have these weekly Wednesday discussions, those of you that don't know, it is recorded. So we do get it posted up for you. We do get it posted up for you. So it'll be available to you on the website. And that is why sometimes if I'm talking fast, which I know I have a habit of doing, especially when I drink a little bit too much of this Irish coffee. And I don't mean the alcoholic kind, guys, but when I drink too much coffee, I do get going sometimes. And I know that I don't revisit things that I might have sped through, because I know you'll have the ability to pause it, slow it down, and play it back as many times as you see fit after the fact. So you can always play this back. You can always watch this back, and you can go through the 3 or 4 different entry methods that we talked about, as well as identifying some various stop loss locations and take profit locations just based around the VWAP strategy in and of itself, or VWAP indicator, if you will, but using strategy based on the VWAP. So we can call it a VWAP strategy. So you are set in that regard. But other than that, folks, I do appreciate you all joining me on another wonderful weekly Wednesday webinar where we talk about something to keep that brain stimulated at the very least. Once again, if you don't use VWAP for the rest of your trading career, you will not hurt my feelings. But for those of you that do, that is exciting for me, because I feel honored to have provided you some type of interest in something, or provided something to you that you found interest on your own. It's always my goal to just give you something to think about, something different to think about, because that in and of itself is healthy, whether it's directly or indirectly used again in the future. But the more we know, the more we have available to us, and the less pressured we feel, and the less bored we feel when we're trading, which can lead to, obviously negative outcomes. So the more we know, usually the better off we are, and the more diversified our trading portfolio can become, and the more we can nitpick trades, because we can pick the conservative VWAP entry, we can pick the conservative, multiple different, maybe a conservative head and shoulders entry. It doesn't matter. But we can pick the conservative entry versions of all the different strategies that we know. And instead of getting bored with when we only know one strategy, picking the conservative one as well as the less conservative one, just to fill in those slots, which is obviously not ideal. But anywho, thank you for sharing your knowledge. Absolutely. I thank you for coming. I do appreciate that very much. Thank you very much for saying that. Other than that, though, guys, I appreciate all of you as well. It's always my goal to just bring you guys something fresh, something to keep you going, something different. Even if we're just talking about some historical information about an asset or diving into the history of something, or we're talking about a strategy, all those good stuff. But once again, I hope everybody has a wonderful rest of your week. Please take the market very carefully, but in stride, guys. Don't think too hard. Don't make it too complicated. Relax, go with the flow. It's not a big deal, guys. Just remember to take things slow, steady, and calculated. That's all it takes, and be consistent, guys. But I will see you all very soon, I am sure. Best of luck, everybody. Happy trading. This has been another presentation. Over and out.